want to be honest with you. I see the struggle every day. Working class people in this city are under real pressure, and for a lot of people, rent feels like something they're constantly chasing and never quite catching. I'm a real estate developer, and I know that for some people, that may immediately make them skeptical of what I'm about to say. But I'm also a renter, so I do understand, at least in part, what it feels like when housing costs keep rising and your paycheck does not seem to stretch far enough. In my last video, I pushed back on Mayor Mamdani's narrative about skyrocketing profits. I pointed to data showing that buildings that are 100% rent stabilized saw income rising only about 2.4%. And once you factor in inflation, even that modest increase is not a real gain.
Wanting to freeze the.
So that is where I want to begin. But I also wanted to wait until we had the latest numbers from the Rent Guideline Board, because if we are going to talk about rents honestly, we need to start with costs. And that brings us to something called the PIOC. PIOC stands for the Price Index of Operating Costs. That sounds technical, so let me say it more plainly. It is basically the city's way of measuring what it costs to run a building. It is an effort to measure the real-world cost of owning and operating housing. Things like labor, insurance, fuel, utilities, maintenance, tax, management. All of the things you have to pay if you want a building to keep functioning. So before anyone says rents should be frozen or owners are making too much money, the first question should be, what does it actually cost to operate the building? Because if the costs are rising, that matters. And if the city itself is measuring those rising costs, that matters even more. That is why the PIOC is so important. It is one of the most important inputs in the entire rent setting process. And if you understand that, then you understand why so many owners, operators, and developers are frustrated by the way this conversation is often presented in the public. So let me slow down and explain how the system is supposed to work. The Rent Guideline Board is not supposed to just sit in a room and pick a random number. It is supposed to study operating costs in detail. It looks at what owners are paying. It looks at what vendors are charging. It looks at inflation. It looks at the basic economics of keeping housing in working condition. In other words, the whole point is to begin with reality. And the board does real research to do that. You can think of it as a detailed cost audit. And it does two things. First, it tells us what costs have already done. And second, it helps us forecast what costs are likely to do next. That forecast matters because rents are not supposed to be set in a vacuum. They are supposed to respond to the operating environment. So let's look at an example. In the 2025 forecast, the board predicted that the building's operating costs would rise by 4.8%. That forecast then helped inform the rent increases for the following year. And the board also uses something called the commensurate rent adjustment formulas. Again, that phrase sounds technical, but the basic idea is simple. These formulas are meant to estimate what kind of rent increases would be needed to keep owners roughly whole as costs rise. Not to make anyone rich, not to create windfalls, just to keep the economics from breaking. In 2025, the Rent Guideline Board forecasted a cost increase of 4.8%, and that helped support a 3% increase for a one-year lease. Then, the 2026 report came out, and we got to compare the forecast with what actually happened. And what it showed was that actual cost increases were 5.3%. So the real increase turned out to be even higher than what had been forecasted. That is a very important point, because the entire logic of the system is that costs are measured, rent is adjusted in response, and buildings are therefore able to continue operating and being maintained. That is the deal. That is understanding. And that is why this process exists in the first place. So now, the next big question is, what does the board think is going to happen this coming year? According to the 2026 report, which came out last week, the board estimates a 4.1% increase in operating costs. And when you look at the report, you see why. There are projected increases in taxes, there are projected increases in labor, and there are projected increases in maintenance. So the overall direction is clear. Costs are still going up. Now, there are some specific assumptions in that report that I personally do not agree with. The board says fuel costs will decline by 7.5% and utilities will drop by 1.7%. And this is where I think it's worth pausing for a second and ask a normal person question. Does that sound realistic to you? Because to me, it does not. With conflicts in the Middle East affecting oil markets and with AI infrastructure creating major energy demand, those projected declines do not strike me as especially believable. Now, to be fair, forecasting is hard. Nobody knows the future with certainty. The larger point remains the same either way. The system itself is acknowledging that costs are going to go up.
For a full year, it's sat vacant because the landlord says it needs $50,000 worth of renovations just to bring it up to code.
Now, let's go one step further. If the city says costs are going up by 4.1%, how does that become an actual rent increase number? This is where people often get lost, so I want to go slowly. The board uses 3 different commensurate formulas. If costs are rising, what rent adjustments would keep the building from falling behind? Each formula looks at that question a little differently. The first is called the net revenue method. The easiest way to think about this is cash in, cash out. What are the bills? How much did these bills go up? And how much more rent would be needed to cover that increase? That's it, nothing fancy. This method looks at the 5.3% jump in costs that we just experienced and asks what rent increases would be needed just to offset those higher costs. For a 1-year lease, the answer is 3.75%. Formula number 2 is CPI adjusted method. This one adds another layer. It says yes, costs went up, but also the value of money itself has changed. This formula takes the 5.3% cost increase and adds an adjustment based on the consumer price index. Under this method, the number is 4.5%. So this one is trying to protect against both rising building costs and the shrinking value of money. Then there is a third formula, the traditional method. This one tries to balance both the past and the future. It looks backward at the 5.3% increase that owners just experienced and looks forward at the board's forecast of 4.1% increase for the coming year. So instead of only asking what just happened, it also asks what is likely about to happen. Under that method, the result is 3.4%. So when you step back and look at all 3 formulas together, what do they tell you? They tell you that according to the city's own framework, a 1-year rent increase somewhere in the range of 3.4% to 4.5% is what keeping up with costs look like. That is an important point, not some wild number, a range tied to city's own math. And to me, that sounds fair on paper. If the city's own research says costs are rising by 4.1%, then a rent increase in the amount of 3.4% to 4.5% range is not some outrageous ask. But here's where things start to break down. Those formulas do not force the board to do anything. They are guidance. They are not binding. And historically, the board has often ignored them. A lot of people assume that if the city has a formula, then the formula determines the answer. But that is not what happens. The formula produces a range. Then the board votes. And the board has often voted for numbers well below what its own formula suggests. The board typically does not vote for anything above 3%, and it does not lower the rents. It ranges between 0 to 3%. And it tells you that the board has repeatedly chosen politically easier numbers over numbers suggested by its own cost framework. And I understand why that may feel appealing in the short term. A low increase sounds compassionate, and from a tenant's perspective, of course, that is emotionally understandable. But the problem is that the costs do not disappear just because the board declines to recognize them. So when the board votes below the level its own formula suggests, it is not eliminating the cost, it is shifting the burden somewhere else. And over time, that creates a hole in the economics of the building. Now, I want to be honest about this. We built a rent stabilized building, but today that building is struggling to hit its projections. Now, I want to be fair here. That is my problem, not yours. I understand that. But I still think the public deserves an honest explanation on why builders are all pulling back from New York City. And the honest explanation is that almost everyone who has invested in new development here lately has lost money. Lenders increasingly look at stabilized buildings not as a safe asset, but as a risky one. That makes refinancing harder, that makes future development harder, and eventually it means fewer homes getting built. There's a common image that every building owner is some billionaire sitting on endless cash. And yes, some owners are very large institutions, but many are not. Many are mom and pop owners who put their life savings into a property. And even when the owner is an institution, that does not necessarily mean some faceless villain. It can mean pension funds. It can mean retirement money from teachers, firefighters, and nurses. That is part of what is at stake here, too. Real estate, especially stabilized housing, is supposed to be a relatively stable investment, not a gold mine, just stable, predictable, and durable. That predictability is the point, because when owners and investors agree to operate within a stabilization system, they're making a bargain. They're saying, we will accept the rules, and in return, the city will provide a framework that is stable enough to underwrite, stable enough to finance, stable enough to maintain, stable enough to build around. I also think it is important to say plainly that Mayor Mamdani is not explaining these formulas to the public because they do not fit the story he wants to tell. A slogan is easier to communicate than a spreadsheet. A villain is easier to market than a system. And public anger is easier to mobilize when people are not being shown the mechanics underneath the issue. But if that anger overwhelms a board's own research, then the result is not justice. The result is that the people financing, operating, and maintaining housing gets punished for participating in the system the city itself created. And once that happens, the whole city feels it. Capital dries up, projects stop, and fewer homes get built. And that is the larger consequences here. So when I look at this year's numbers, my view is pretty simple. The board should begin with its own cost research. It should take the formula seriously. And it should stop treating math as optional when the long-term health of the city's housing stock is on the line. The Rent Guideline Board holds its preliminary vote on May 7th. My hope is that before that vote, they look carefully at the forecasted cost increases, look carefully at the rent adjustments suggested by the formulas, and make a decision based on the system they themselves are supposed to uphold. Because if they do not, then once again, they are gambling with the city's housing stock. Thanks for listening. I'll see you in the next one.